It's all about inflation this week on Gen Wealth Radio, and we are keeping the theme going on the fastest 4 minutes in finance with a closer look at the latest data. Hi again, I'm Scott Inman. So just how bad is inflation right now? Well, the Consumer Price Index December data was released last week and revealed a 7% jump year over year. That's the highest inflation number we've seen on that index since 1982. If you exclude food and energy prices, the number was 5.5%. That's the highest reading since 1991 for that measurement. Inflation did slow down month over month, though. Prices were up 0.5% from November to December, which was 0.8% less than October to November. Used car prices were up again, 3.5% in December and now 35% for the year. Prices for shelter, excluding energy, rose 0.4% in December, slightly lower than October and November. Apparel and household furnishings also saw a pretty big jump. It is obviously a pain point for consumers. But what does it mean for the overall economy? Well, first, it's important to note that the number was not entirely unexpected. Inflation has been tracking up since 2020, as we all know. We've discussed before the reasons, but a quick review. We know that the economic shutdown created much of it. Supply chain disruptions and labor shortages are still happening, and that is driving inflation higher. Our friends at LPL Research tell us they do expect it to peak, though, by the middle of the year, and then gradually begin to drop to more historical averages like 3 or 4%. The other key economic factor in play is the Federal Reserve. Analysts are blaming the January market sell-off on jitters over rate hikes. But those same analysts also said the market had already priced in a rate hike. So what gives? Well, those investors are expecting the Fed to raise rates in 2022. What they don't know, and what has investors worried, is how many times they'll do it and by how much they'll raise it. And that comes back to inflation. If higher inflation persists, it may set the Fed on a more aggressive path. Chairman Jerome Powell has told Congress that if it becomes necessary to fight inflation more aggressively, the Federal Reserve is prepared to accelerate the interest rate hikes it plans to begin this year. The Fed's benchmark short-term rate is near zero, but is expected to be raised 3 times in 2022. How much they raise it may have markets spooked right now. As we record this, the S&P 500 is down 4% this month. The Dow is down nearly 3%, and the NASDAQ has plunged over 7%. LPL Research still believes other economic factors suggest that the stock market can absorb the first few rate hikes, as they typically have historically. But persistently high inflation would bring a more aggressive Fed into play. That is not their expectation, though, and they say there was nothing in the December data that changed that. The research team still believes inflation will peak in the next couple of months and begin to come down slowly for the rest of the year. We will keep watching. That's the fastest 4 minutes for this week. Thank you for listening.